Hey, Brian.
Hey.
Hey. So I've had a few appointments over the last few weeks. People in different places, different stages of their lives, but there's been a common theme of having money sitting, whether it be with an old employer, an old 401k, maybe
Yep.
an old investment account. And I'd really just love to open the conversation to, are there any benefits or pros and cons of leaving it where it is, or potentially maybe taking a little bit more control over that money or that account?
Yeah, that's a great question. Almost 20 years in the business now. I've come across this a lot. I used to work for this company 5-6 years ago. I left, and my whole 401k is still there. I haven't really done anything. It's done well, or I don't really know what's going on. So to the question of, is it good to leave it or move it? That's a case by case situation. However, a general principle to consider is, if I'm leaving my money in the 401k of my old employer, I'm limited to whatever options are in that old 401k plan. I can only choose investments that are on the menu of that 401k plan. And using that analogy of the menu, if you're working at a company right now and you have a 401k plan, you're not going to have access to everything, a whole universe of options. It's like you're at the diner. And when you're at the diner, you can only order off of what's on the diner's menu. And for those of us who are here in New York, a lot of the diners have like 20-page menus. You're like, how the heck do they keep all this food fresh in the back, right? You can only order off of what's on the menu. You're not going to sit at the diner and say, man, the Thai restaurant down the street has got some really good Tom Yum Kai. Could you go down the street and get that for me and bring it here? You're eating at the wrong restaurant. Meaning, when you're in that 401k plan, whether you do work there or you left it years ago, if your money's in that plan, you're limited to what's available in that plan on that menu. Now, some plans, not all, some plans offer something called a self-directed option. That's usually where they offer you a stock brokerage account where you can buy stocks, bonds, and mutual funds. Not all plans do that. You're typically going to find that through the bigger brand names like a Fidelity or maybe a Schwab, right? But most of the time, we don't see that. You see a person who's got a limited option. So to the question, is it better to move it or keep it? Well, again, case specific. We got to take a look at what else is going on in that person's financial life and their portfolio and their whole plan. But from a general principle, if I'm comfortable being limited with my choices, leave it there. If I'm uncomfortable with that, I want more choice, I want more options, then let's consider moving it, right? So we won't get into making recommendations because this is not advice. This isn't counsel to do one thing or another. I encourage people to sit with a financial professional, someone who's licensed to do these things, and walk through the pros and the cons of moving it or leaving it where it is. But one thing that does come up a lot is the process. How do I move it? I don't work anymore. I want to roll it over. Or I want to get it out of that plan. I want to move it to something else. So there's a couple of things to consider here. The first is the question of, am I going to get taxed if I do this? Well, the answer is maybe. And that depends on if you take the 401k money and you put it into your checking account, let's say. You just take what's called a withdrawal. Now, typically, if you just withdraw it from the plan, they're going to withhold income taxes, right? And they'll also tell you in something called the special tax notice that if you are under 59.5 and you take a withdrawal, you will not only pay the income taxes, you'll also pay a 10% penalty. Now, there are a couple of reasons why you can avoid the penalty. We're not going to get into those right here just for brevity's sake. But if I have a bigger 401k company, like again, a Fidelity or a Schwab running my plan, many times they will do what's called an internal rollover. So my 401k now becomes an IRA, an individual retirement account, also known as a traditional IRA, which means it's taxed later when I take it out, just like my 401k would have been if I left it in a 401k. Sometimes this will happen automatically. It gets rolled over from or transferred from a 401k with whichever company to an IRA within that same company. Sometimes this happens automatically after a certain amount of time for people. Now, the advantage of that is if I go from, say, a Fidelity 401k to a Fidelity IRA, now I'm probably going to have access. I should have access to all of the Fidelity ideas versus whatever was just on the menu of my old company, right? Hold an internal rollover, internal transfer. That can happen. And if the person's like, I love to tinker, I study the markets, cool. Have at it, man. Go for it. You're right. You can do that there within that IRA in the company, Schwab, Fidelity, whoever it might be. It may, however, make sense to roll it out of that plan into a traditional IRA that is now yours, meaning you can move it wherever you want and not pay taxes, as long as we had a regular 401k. And when I say regular 401k, I mean a 401k that does not have the word Roth in front of it. Roth 401ks are tax-free when you take it out. Same process applies, however. I can move a Roth 401k into a Roth IRA if I don't like the menu of choices in my Roth 401k, but we don't see that many of those Roth 401ks. Frankly, too few people take advantage of it. Not many companies, not all the companies who sponsor 401ks offer it. More likely, we're seeing people who have regular pre-tax funded, meaning they invested a seed and now they have this big harvest, pre-taxed 401k money. When you roll it over, you're going to move it into a traditional IRA. That goes from a tax-deferred account to a tax-deferred account. So the IRS can't tax you on it because you didn't take the money and put it in your pocket, right? So there's two ways to do that, a rollover. The first is what's called a 60-day rollover, where the old company writes a check made payable to you, the old employee, or the account owner. And they'll say, Paula Calabrese, here's your check. Now, 60 days means from when you get that check, or the date the check is issued, you've got to go deposit it into a traditional IRA, 60 days. Otherwise, the entire amount is included in your taxable income that year. That might sting. And if you're under 59 and a half, you got to pay the 10% penalty on top of that. So that means if they're going to cut you a check made payable in your name, no taxes are withheld, you have 60 days to move that into a traditional IRA to avoid a tax problem or tax and penalty. The second way to roll over money, and by the way, you can only do a 60-day rollover one time each year. So if I did that leaving a 401k and I dropped it into something, I can't then write another check to myself and do another 60-day rollover. No, I'm not able to do that. I can, however, do the second choice, which is what's called a trustee meaning the person, the company, the custodian of your 401k money, whomever it might be, whatever the company's name is printed in the corner of your statements. Trustee to trustee transfer. And what that means is the check is not made payable in your name. It's made payable to your new IRA. So you'll see, let's just say, you're moving it from Vanguard to Prudential. Vanguard will cut a check that says make payable to Prudential F for B benefit O of Paula Calabrese traditional IRA. So you'll see it'll say make payable to Prudential. So the IRS can't say, you got the money, you got it, you got to pay that. No, you didn't get the money. There was no what's called constructive receipt. It went from trustee to trustee. You can do that as many times a year as you like, right? And I say this to you because sometimes you'll call the 800 numbers and the customer service people are trying to retain the money because remember, you're paying operating expenses on these mutual funds in your 401ks or your IRAs, or might even paying advisory fees on top of this. These companies don't want to see that money go. Remember, the game on Wall Street is some three little letters, AUM, assets under management, on which they can charge fees, and that's how they earn their revenue. they're going to do whatever they can to dissuade you from moving it. The number one thing that I hear from people when it comes to the rollover and why they left it at the old company is, I was afraid of making a mistake. There were so many forms. I just was confused and I didn't want to create a tax problem. That's where we come in, simplifying this process for people. If you want to do a trustee to trustee transfer, one of three things is going to happen. The company, your old 401k, will tell you either we have our own paperwork that you need to complete. We have our own set of forms. You need to complete our set of forms, and maybe you might need to get someone from the old human resource or the old company's human resource department, a plan administrator. We need to get them to sign off. In some cases, if you're married, they want your spouse to acknowledge that you're rolling the money, you're leaving that plan, and get that signature of your spouse notarized, right? So the first situation is the old company says, we have our own paperwork that you need to complete, right? The second scenario is where they say, oh, you're moving your company from this company to another one, from ours to a new company. Well, tell the new company to send us what's called a transfer request, which is a couple of pages. And on it, you're saying, please send my money from old company to this new company, right? Now, if that's the case, they say, oh, yeah, we'll take the new company's paperwork. You'll want to ask, and if you're working with a professional, they'll know to do this. You want to ask the old company, hey, this new form, or this new company's form, does it require a medallion stamp? And some of you guys listening, like, a what? Right? A medallion stamp is something in the financial industry that's similar to what a notary is in the regular world. A medallion stamp you typically get at your bank, not any bank, but the bank that you do your banking with. And what it means is you go there with this transfer form saying, I'm leaving one company and I'm transferring this money to the other one. And the person at the bank stamps it. It's a green stamp. It's big. It's going to get embossed too. It's kind of cool. Then we send that in to the old company and they'll release the funds. Now, sometimes, remember, the old company doesn't want to let go of the money. They might lose that paperwork. They might slow walk it. You got to be on top of it, confirm that they received it, check in with them every couple of days to make sure it's in process. And then what'll happen is they'll cut that check made payable from the old company to the new company. And typically what they're going to do is they're going to send that check to the address they have on record. Typically, they'll send it to you. You can't do anything with it. It's not made payable to you. It's made payable to your new IRA. So you don't have to worry about the IRS showing up at your door, right? That's not going to happen because the check was not received by you. It was sent from one trustee to another trustee. It just happened to land in your mailbox, and then you forward it on to your new company, right? Third scenario, if the first one is the company has their own paperwork, the second one is they'll take your new company's paperwork, a transfer paperwork. The third scenario is where they'll actually take instructions over the phone or on their website. Just punch in the name of the company. They might ask for the address. They might ask for an account number. In a lot of cases, you can reference a person's last four of their social if they're in the process of, for a lot of people doing this. Or if you have the account already set up, you just use the account number there. If you don't, you can, last four of your social. Take the instructions over the phone or online. Very simple. You just need to know where it's going, the name of the company, and typically an address to where it to be sent. Again, the check likely would be sent to you as the account owner, and then you forward it on. Or if you're lucky, they'll send it to the new company, which is why they'll want to ask for the address. Now, that's the three ways you can roll over money. This is the process. Now, there's two things that we got to consider here. One thing mainly. If you decide you want to leave and you want to move to a new company, you have a choice. If I'm going, let's say, from an old 401k to a brokerage account, maybe like whatever, Interactive Brokers or Schwab or whatever it is, and I don't want to get rid of my funds. I want to own my funds. Maybe I have stocks. Maybe I have bonds in there. I don't want to sell them. I like it. I believe in it, but I don't want to deal with this company, their costs, their service. I want to leave them. I want to transfer this money to another broker, but I don't want to sell my positions, that's when you would do something called an ACATS transfer. 9 out of 10 people are not going to do this, by the way. But if you're so inclined, if you're listening to this and you don't want to sell the thing you have, again, if you're in a 401k plan, you're only limited what's on the menu. Chances are you don't want what's on their menu anymore when you see what else is out there. But if, let's say you had an IRA and it had some stock positions that you bought years ago, like, man, I got a great cost basis. I don't want to sell this. You do what's called an ACATS transfer. It goes from your old brokerage to your new one, and you own the same stuff. There's no sale. It's just they transfer the ownership, the custodianship, from the old company to the new company. Not going to happen for most people leaving a 401k. It's going to go from the old company to new company as cash, which is the key here. If you want to do this, you're like, I want to roll my money over. I don't want to keep it there. You have to tell them to sell whatever mutual funds you own and put that money into the money market. Because whichever company you're sending it to, they're not going to take those mutual funds. Let's say you're moving from that to an annuity, right? Well, the annuity is not going to take that. You need cash. And the old releasing company is not going to release those mutual funds because it's not an ACATS transfer. They're like, well, we can't do this until you sell these funds. So you will have to sell the funds you own and move it into a money market or a cash account in your old 401k. Then they'll cut the check. Typically, we do this on a phone call. Once we've decided, the couple says we're going to move our money here, we get all the approval done from our back office. Okay, we call the company and we find out what their process is. And on that phone call, we'll have them sell whatever funds and move it into the money market so that the money is not exposed to, gyrations in the market, and it can go right to the new plan. So make sure it's liquidated into cash within the 401k before it's moved. The second thing that happens. Now, I say this because, remember, they don't want to let go of the money. So if you say transfer it, but you don't liquidate it, they're like, oh, we can't do it. We didn't do it because you didn't tell us to sell. You're like, no, I told you to transfer it. Yeah, but you didn't tell us to sell. You're like, I didn't know I was supposed to do that. Yeah, all the while they kept your money, and naturally they're earning fees on it, which is their game. So a second thing that we have to be aware of when we do this is the old company is going to ask you, did you get what's called a special tax notice? All that means is if you take the 401k money, the IRA money, and you put it in your pocket, you got to pay taxes. If you're under 59.5, you're going to have to pay a 10% penalty on top of the taxes. If you're over 59.5 and you take the money out of your 401k, put it in your pocket, you just pay taxes. Special tax notice, right? Now, if you go from IRA or 401k to IRA, traditional IRA from 401k, you don't owe any taxes. You can do it 60-day rollover style, or you can do it trustee to trustee style, right? So this special tax notice tells us all the stuff that we already know. We can find out on Google. Why is this important? Because when they ask you, or if you're doing it on the phone or on their website, there'll be a radio, like a little box. Did you get the special tax notice? You want to check yes. You want to answer, yeah, I did. Reason being is that all that information is freely available. You can Google special tax notice right now and read it. But if you tell them, no, I didn't, they're going to drag their feet. Well, we can't do anything until you've received it and had a chance to read it. And that might be 2 weeks, 3 weeks, a month, because they're going to send it to you snail mail, right? And say, well, we can't process anything until you've gotten it. We have to wait then X amount of days to make sure that you've gotten it. In the interim, you might be panicking because you want your money out of there. No, can't until you get the special tax notice. We got to make sure you read it, right? So working with an advisor, it's important that we make sure that people understand the simple aspects of it. You take this money out, put it in your pocket, you're going to pay taxes. If you're under 59.5, you're going to pay tax and a penalty. We roll it over from your traditional 401k to a traditional IRA, you're not going to pay any tax when you do that, right? We could do it in a 60-day way, or we could do trustee to trustee way, right? Either way, if we go from 401k to IRA, you're not paying taxes. That's what the special tax notice is. And again, we want to liquidate it to cash because they're not going to send like-kind stuff. If you're going from a 401k to an IRA with a brokerage account and you want to keep the stocks and bonds that you owned, you might be able to do what's called an ACATS transfer. But the point about all this is it's way easier than people believe. The industry wants people to think this stuff is really difficult to understand. but it's just like changing a flat tire. The first time you did it, like, oh, no, what's going on? You don't hope to do it. You don't hope to get laid off and have to roll over your 401k. But it's not that hard. The reality is, though, the industry would rather people think this stuff is super complex, super difficult to grasp, so that we panic and we don't do anything. We get what's called analysis paralysis. We leave our money there. Might not be where we want it to be. We might believe we have no alternative, no other option. And that's entirely not the case. There are some hoops you do have to jump through, but they're not that difficult. And once you understand how the process works, you're the one in control. And when you're on the phone with people, the most certain person always wins. Once we help people understand the simplicity of this and why the companies ask these questions and why they do it this way, many times people get pissed off. Like, what the? I know. Let me help you understand how this works. This way you don't get taken advantage of, and you do it in a way that the IRS won't come knocking.
Thank you, Brian. I think it's really helpful, even for me. Like I spoke to you about this personally, and it could seem overwhelming at first, but what I love about your approach is you lay it out all on the table ahead of time. So I think just instinctively knowing what the process will be like, or having a little bit of an understanding, hey, there's going to be a few different options. We want to just know these options ahead of time. I think from a client perspective, that would put me at ease, just knowing, okay, this person already knows what to expect and they're guiding me. So I think that is, something that could be really helpful or really beneficial for people, and thinking about who they're going to reach out to, who they're speaking to get this information from. They want someone that sounds like you, that really can put it, into perspective, and that it's a little bit less scary when you're like, we know this is coming. We're prepared for it.
Absolutely. As they say, an ounce of preparation is worth more than a pound of cure. And this stuff is not that hard.
Well, thank you, Brian. Thank you for simplifying things and leaving us with a little bit more information than when we started. So we appreciate it. On Things That Matter with Brian Batter.
I'm always going to laugh at that.
Me too.